Welcome to the Deep Dive, the show where we cut through the noise, distill the essential, and bring you those surprising facts that make you truly well-informed. Today, we're plunging into a really fascinating nexus. How the world of cryptocurrency, originally born out of this desire for decentralization, is now deeply, almost ironically, tangled up with the oldest parts of our financial system.
Yeah, the really foundational stuff.
Exactly. We're talking government bonds, central bank actions, and the national debt that, well, it affects us all. This isn't just about speculative digital assets anymore.
No, not at all. For some, crypto is becoming a critical participant, maybe even a potential safeguard, especially when you look at these very traditional financial challenges.
Right.
So our mission in this deep dive is really to unpack these complex connections. We're looking directly at the latest research, expert opinions you've shared, exploring how stablecoins are, actually influencing US Treasury rates.
And how Bitcoin is viewed.
And how Bitcoin is increasingly seen as a hedge against fiscal instability, and what all of this tells us about the maybe underlying pressures on the traditional bond market.
So we're here to help you understand the what, and maybe more importantly, the why it matters.
Absolutely. Why it matters for the broader economy and maybe even for your own financial outlook.
Okay, so let's start with a player you might not expect to see right at the heart of the US Treasury market, stablecoins. Now, for anyone new to the term, stablecoins are basically cryptocurrencies designed to keep a stable value, usually pegged one-to-one with the US dollar.
Like digital dollars almost.
Yeah, think of them like that. They offer benefits like instant settlement, censorship resistance, all while trying to avoid that wild volatility you see in other cryptos.
And their presence in the Treasury market isn't just significant, it's pretty amazing, actually. The Bank for International Settlements, the BIS, the central bank for central banks. They recently revealed that stablecoin issuers like Tether, that's USDT, and Circle, USDC, were actually the third largest purchasers of Treasury bills in 2024.
Third largest, wow.
Yeah, and this isn't some small slice. It's based on the net increase in their reserves. We're talking around $40 billion in T-bills purchased.
$40 billion, that's a staggering amount, isn't it?
It really is.
I mean, put that in perspective. They're buying T-bills almost like the biggest U.S. government money market funds. And they've even passed what whole countries like China hold.
That's right. And by March 2025, their combined assets under management, so all the money they're handling, had shot past $200 billion.
$200 billion.
Yeah. More than the short-term U.S. securities held by lots of major foreign investors. And Tether, just Tether alone, claimed it held more U.S. Treasuries than all but 6 other countries.
That really makes you pause, doesn't it? The scale of this new player.
And what's truly fascinating here is their market dominance. USDT alone had $150 billion. USDC got to $60 billion. This was Q2 2025.
So together?
Together, they basically are the stablecoin market, roughly 90%. And their trading volume. Combined, it just exploded. $23 trillion in 2024.
23 trillion.
Yep. A 90% increase from 2023. So this isn't some, niche corner of finance anymore. It's huge. It's growing fast.
Okay, so with numbers like that, clearly they're not minor participants. This BIS research you mentioned from May 2025, it shows a direct impact on Treasury rates, right?
Yeah.
But it's asymmetrical.
Exactly. That's the key finding. They found that, let's say, a $3.5 billion purchase of treasuries by these stablecoin issuers, it causes about a 3 basis point decline in short-term treasury rates.
Okay, 0.03%.
Yeah.
Small, but you can measure it.
Right, measurable. But here's where it gets really interesting and maybe, a bit concerning. A sale of the same size, $3.5 billion, that causes a much bigger effect, a 6 to 8 basis point increase in those same rates.
Whoa, double the impact or more.
Yeah.
Why the difference?
Well, the thinking is it's about urgency. Sales often happen because of mini crises or maybe even a sudden run on a stablecoin where people rush to cash out.
Right, they need the cash fast.
Exactly. So they have to sell treasuries quickly, maybe at less favorable prices, and that forces rates up more sharply. Imagine if a major stablecoin had a crisis and had to dump billions in treasuries onto the market all at once.
That could send ripples everywhere.
It could. It definitely raises this big question about financial stability. If a run on a major stablecoin forces these huge, rapid sales of their treasury holdings, well, it could potentially destabilize other markets, too.
Because treasuries are the benchmark, right, for everything.
They're the global benchmark for countless financial products. If their prices start swinging wildly, well, so could everything else that's built on top of them. And this also brings up something people have called the Greenspan conundrum. Remember back in the early 2000s?
Vaguely, yeah.
Yeah.
Large foreign holdings of treasuries.
Exactly. Those large offshore holdings made it harder for the Fed to actually influence interest rates effectively. The worry is that today, these huge stablecoin volumes could do something similar.
Potentially weakening the Fed's control over monetary policy.
Potentially, yes, eroding their control. And there's a big policy debate starting around this. Some laws being proposed actually encourage stablecoin issuers to hold government debt.
Which sounds good on the surface, maybe. Helps fund the debt.
Some see it as positive, yes, but others worry it reduces the central bank's independence, makes their tools less effective. Especially, when you see government debt levels ballooning globally like they are, it's this constant, complex dance between government spending and trying to control the money supply.
And it's just deeply ironic, isn't it? As Professor Eswar Prasad at Cornell pointed out, crypto was meant to be an escape from traditional finance, from government control.
Right. The whole point was decentralization.
And now it's becoming deeply intertwined with government debt. Almost like the system it wanted to replace is now, in a way, being propped up by crypto's own growth.
It's a strange loop.
Okay, so that's stablecoins. But then there's Bitcoin. Its story is different, right? It plays another kind of role in this whole shifting landscape.
Yeah, definitely different. Bitcoin's increasingly seen less as just, a speculative bet and more as a strategic asset, maybe even a protective asset.
Protective against what?
Mostly against concerns about U.S. fiscal mismanagement, the long-term health of traditional currencies like the dollar. That narrative is really gaining traction.
The hedge narrative.
Exactly, the hedge narrative. You look at Max Kaiser's theory, for instance. He argues that companies like MicroStrategy, Michael Saylor's company.
Like one holding tons of it.
Over 214,000 Bitcoin last I checked. They're strategically using cheap debt, like corporate bonds, convertible notes, to buy Bitcoin. Basically as a hedge against inflation and, monetary instability. The bet is that Bitcoin's value will outperform the cost of borrowing that money over the long run.
Which, if you look at it from a more conservative viewpoint, that's a pretty strong statement about their lack of confidence in traditional money and government finances.
It absolutely is. It signals a deep skepticism. And think about it. If more companies start doing that, copying that playbook.
What happens to the bond market?
Well, you could see real pressure building. More capital flowing out of traditional debt into digital assets like Bitcoin. That could potentially lead to bond yields spiking, prices dropping.
And what makes Bitcoin compelling here, specifically?
A key thing is its low correlation with treasuries. It just doesn't tend to move in sync with them. So for people worried about inflation, looking to really safeguard their savings, Bitcoin offers a genuinely different kind of protection.
Interesting. So it's not just a hedge, it's also about diversification.
That's a big part of the appeal, yeah. Potential portfolio diversification. I mean, despite its reputation, and it often acts like a risk-on asset.
Meaning it does well when investors feel confident.
Right. It was the top performer in 9 out of 12 years between 2012 and 2023. But even so, its correlation with the S&P 500 measured over 50 days tends to be quite low, often between 0.2 and net is 0.1.
So it often zigs when the stock market zags or just does its own thing entirely.
Pretty much. It moves independently a lot of the time.
And that's important because traditional hedges, like treasuries, they aren't acting like they used to.
That's a really key point right now. Recently, US Treasuries have actually shown an increasing positive correlation with stocks, meaning they might fall at the same time stocks fall in a downturn.
Which kind of defeats the purpose of holding them as a stabilizer.
Exactly. It diminishes that traditional hedging benefit. Bitcoin, though, offers this different, genuinely uncorrelated behavior that's looking more and more attractive to people.
And we've seen it hold up during crises.
We have. Surprisingly resilient sometimes. Remember the banking stress in March 2023? Credit Suisse, Silicon Valley Bank collapsing?
Yeah, a scary moment.
During that period, Bitcoin actually appreciated roughly 20.5%. The S&P 500 was up, but only about 5%.
Wow.
So that kind of behavior, which really stems from Bitcoin being born after the 2008 crisis as this decentralized alternative, It highlights its potential as maybe a safe haven when the traditional system looks shaky.
And institutions are noticing this.
Oh, absolutely. Institutional interest is definitely growing. You see investment advisors putting more into Bitcoin ETPs, these exchange-traded products. There are even reports, whispers really, of central banks, sovereign wealth funds looking at Bitcoin as a way to guard against bond market downturns.
Yeah, and Coinbase joining the S&P 500 index.
Right. In May 2025. That's a huge signal, isn't it? It's bridging these worlds that used to be totally separate. It shows institutions are acknowledging Bitcoin as, well, a legitimate asset, even if it's still unconventional for many.
Okay, so this brings us to the bigger picture. Why is all this happening now? What's going on in the traditional financial system that makes crypto, both stablecoins and Bitcoin, so relevant? Because it feels like there are some serious pressures building.
There absolutely are. We're seeing, let's call them significant cracks appearing in the foundation of the traditional bond market.
Starting with U.S. debt.
Starting with U.S. debt and what it's doing to the banks. The reality is, well, it's pretty unsettling. Some analysts straight up describe the U.S. banking sector as essentially insolvent.
Insolvent. That's a strong word.
It is, but it's because they're sitting on over $500 billion in unrealized losses on their balance sheets. These are paper losses for now, but they're huge.
And that's from the Fed raising rates.
Largely, yes. The Fed's aggressive rate hikes back in 2023 just hammered the value of all the Treasury bonds the banks were holding. Killed their value, essentially.
And didn't some emergency program end recently?
Right. The Bank Term Funding Program, the BTFP, that expired in March 2025. It was letting banks temporarily park these devalued bonds off their main books.
Okay.
When it ended, those distressed bonds had to come back onto the balance sheets, but now showing even bigger losses because rates stayed high or went higher. It compounded the problem.
And meanwhile, the national debt itself
Is nearing historic highs.
Right.
We're approaching, $38 trillion. The debt-to-GDP ratio is almost 130%. These aren't just numbers on a page. They represent a massive burden.
and the cost of servicing that debt.
That's what's particularly alarming, especially if you're looking at it from a fiscally conservative angle. The interest payments on the federal debt, they've quietly jumped up to 14% of the entire federal budget in 2025.
14%, just on interest.
Just on interest. Second only to Social Security. It was 11% in 2024. That's money just going to pay for past borrowing, not for current services or investments.
And the Treasury has to refinance a lot of old debt soon.
A huge amount. They face refinancing $9.2 trillion of existing low-interest debt in 2025 alone. Now, imagine if they have to roll that over at today's higher interest rates, yields above 5%.
How would be?
In the words of some analysts, disastrous for the federal budget. The interest payments would explode even higher.
Which leads us, I guess, to the Federal Reserve's actions. Because officially they're doing quantitative tightening, QT, right? Shrinking their balance sheet.
That's the official story. But what they're actually doing, well, some analysts are calling it stealth quantitative easing. Stealth QE.
Meaning they're effectively printing money again. Quietly.
Effectively, yes. Look at the tapering. They were supposed to be letting $60 billion in treasuries roll off their balance sheet each month, not replacing them.
Okay.
They cut that aggressively, down to $25 billion a month in March 2024, then down to just $5 billion a month by March 2025.
$5 billion? That's barely anything compared to $60 billion.
Exactly. At that rate, they're effectively net buyers of treasuries again because the government is issuing so much new debt.
And why are they doing this? Is the market just not buying the debt otherwise?
That seems to be a major factor. It's described as weak private market demand. There was 1 week where the Fed had to step in and buy $43 billion worth of treasuries just to relieve pressure on banks and keep liquidity flowing.
So they're propping the market up.
Many see it exactly that way, trying to prop the market up, avoid a liquidity crisis. But the concern, from that conservative perspective again, is that this prevents real price discovery for bonds. It just kicks the can further down the road, masking the underlying problem.
And the ultimate consequence of all this debt, this potential stealth QE, what's the fear?
The fear, the anticipated consequence, is pretty profound. More money printing leading to currency debasement.
Meaning our money buys less.
Exactly. Inflation, especially asset inflation. It makes it harder and harder for ordinary people to afford basic things like real estate. It acts like a silent tax, eroding the value of your savings, making that dream of ownership just further away.
Which loops us back to Bitcoin, maybe. And why some traditional players might not like it.
It connects directly. Think about traditional banks. Their whole business model, largely, revolves around lending out money. Money they often create effectively out of thin air, through fractional reserve banking without the hard constraints of something like gold or
Bitcoin with its fixed supply.
Precisely. So if you see a significant sustained shift of funds out of the fiat system, out of dollars, and into a decentralized, constrained asset like Bitcoin, well, that could be genuinely disastrous for their established model. It's a move away from centralized control and unlimited credit creation, which is the foundation of their business.
So wrapping this up, we've really covered a lot of ground. We've dived into how stablecoins aren't just crypto novelties anymore. They're major players in the US Treasury market.
Yeah, directly impacting interest rates, potentially even messing with monetary policy effectiveness.
And then we saw how Bitcoin is carving out this role as, well, maybe digital gold, an alternative, a hedge for both big institutions and regular investors.
Especially against this backdrop of, frankly, worrying levels of U.S. government debt and these questions around the bond market stability and what the central banks are really up to.
The lines are definitely blurring, aren't they, between traditional finance and crypto? It's happening fast. And these new connections, these interdependencies, they bring chances for diversification, sure, but also new kinds of systemic risks we haven't seen before.
Absolutely. So maybe the thought to leave everyone with is this. As the traditional financial system is wrestling with this unprecedented debt, these big shifts in monetary policy, and as these decentralized alternatives are gaining more and more traction, what does this ongoing dance between the old and the new truly mean for the very definition of safe money?
And maybe more importantly, what does it mean for your future financial stability? Something to think about.